Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Giga Metals. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the bottom left of the slides. Once the Q&A session is ended, don't log out. You'll automatically be transferred into the Giga Metals booth, where you can continue to ask questions via chat and access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Mark Jarvis, CEO and Director of Giga Metals Corp., which trades on the OTCQX Best Market under the symbol HNCKF and on the TSXV under the symbol GIGA. Welcome back, Mark.
Well, thank you very much, Bob. And it's a pleasure to be here, and I want to welcome everyone to this presentation. It's a very interesting time for us right now. Nickel has just broken above $9 a pound in the last few days, and it seems that inventories on the London Metals Exchange are down almost every day for the last couple of months. So we're speaking at a time where the supply of nickel seems to be tightening up, and where people that are battery manufacturers and people with the ambition to manufacture electric vehicles are realizing, wait a minute, where are we going to get all the nickel we need? So with that, I'll just launch into this. Here's a standard disclaimer. You can read this on our website at your leisure. So who are we? Well, we're a very small mining company, a junior mining company with an extremely large deposit of nickel. And we've recently done a PEA that models building a nameplate capacity of 37,000 tons a year of nickel with associated cobalt, and with a 37-year mine life. That is a really large operation. We own 100% of it. And typically when you've got a very small company with a very large deposit, at some point you need partners, because every stage of development is expensive. And so at some point you want partners to get involved at the project level rather than at the stock level. And we are very actively engaged with actually many discussions with potential strategic partners on that. And that's being handled by our president, Martin Vidra. I'll get into that a bit more later. So here we are in north central British Columbia. It's a very good mining jurisdiction. Part of why it's a good jurisdiction, British Columbia and Canada have very high environmental standards. So, it is not trivial to get a project, especially a large project, approved. However, it is possible, and it's done all the time. But one of the implications of that is that if you are sourcing your metal from a Canadian mining project, you can be comfortable about the ethical implications of sourcing your material in Canada. So some of the project highlights, again, you can see at the right, we've got an extremely large resource, 5 billion pounds of nickel in the measured and indicated categories alone. And then plus in the inferred category, we've got another 5 billion pounds. And the deposit is still open. We haven't closed it off with drilling. It's just we got to a certain point and said that's enough. But we feel like about 25% or less of the total potential deposit has been drilled off. One of the strengths of this project is the simplicity of the flow sheet. You dig the rock out. It's going to be an open pit mine. So you crush the rock, you grind it, and then you put it through froth flotation. These are all old, reliable technologies. They're not complicated. They're simple. And it's very similar to a copper porphyry type of mine in terms of the processing. The only difference is there's different chemicals used in the froth flotation, between copper and nickel flotation. And this results, we start with a low-grade ore, but it turns into a very high-grade and very clean concentrate, which gives us multiple options for further downstream processing. Another feature of this project is that our tailings, our silicate tailings, will absorb CO2 directly from the atmosphere. And we can measure this. And so the CO2 gets absorbed from the atmosphere into the minerals, and it converts the silicate minerals into carbonate minerals. And the CO2 becomes part of the mineral, and it's basically gone forever. So it's not like carbon capture and storage, where if you're storing it, it could always leak. It becomes part of a rock, and it's gone for geological time periods, for practical purposes, forever. Here's our project timeline. I myself, this was put together by our engineer, who's very conservative. I think this is maybe even too conservative. We're giving ourselves a couple of years from doing the feasibility study and completing the environmental assessment to get financing. If we get the financing quicker than we've modeled here, our startup could be sooner than 2028. But simply large projects take a long time to bring into production. And that's part of the reason why, nickel could be in, particularly battery grade nickel, could be in significant shortages in the coming years. This is the concentrate that we can make. We can make it reliably. We've done a lot of metallurgical test work. And one of the features of this is it's very low in deleterious elements. So 18% nickel, 1% cobalt, roughly we can do, reliably day in and day out. This is a very nice product for a smelter to buy. It would command a premium price at the smelters. But we've also got options for further processing downstream that we're looking at right now. So what we're looking at right now, and what we may be modeling, I'll be bold. I'll say we'll probably be modeling this in our pre-feasibility study, which is what we're getting to work on now, is taking our concentrate and processing it the next step to a product known as mixed hydroxide precipitate. We've done test work on our concentrate before, and we know that we can make a very high quality MHP, high grade with very low manganese, low magnesium, and very low copper and iron. So this is what you're looking for in a quality MHP product. The reason we're looking at this is that battery manufacturers are crying out for this product. Nickel isn't like, say, copper or gold, where you just make metal and sell the metal. Nickel has many different forms it can take and many different chemical forms. This particular chemical form, MHP, that's what the battery makers want. And people that are manufacturing MHP right now, basically as fast as they can make it, it gets sold. And it gets sold at very nice premiums with very nice payables. So, we think that the extra capital cost of adding a circuit at the end of our process and the extra operating costs will be more than made up for by the extra payabilities of the nickel and cobalt. So that's the basis that we're proceeding on. In terms of tailings management, we've got a very nice location for our tailings that makes a lot of sense. We have designed quite an expensive tailings management facility because it is the safest tailings management facility that you can make. It's a modern, very modern centerline construction type of tailings facility, which will have a low amount of water. It won't be filled with water. It'll have room for these beaches of basically silicate sands, which will be our tailings. And it's designed that way to expose these silicate sands to the atmosphere so they can absorb CO2. One of the things that happens when you do this, as the silicate sands absorb CO2 and convert to carbonate minerals, they also go through a process of cementation. So we're designing the safest possible modern tailings management facility, but if you add in the cementation, it's very difficult to see, how this dam could ever be breached. Plus, we're in an area of very low seismic activity. We put this slide together. This is quite interesting. It's a 40-year history of nickel prices, and with the black line, the prices are adjusted for 2020 dollars, so they're adjusted for inflation. And when you do that, I was surprised to see that the average price of nickel for the last 40 years is $11 a pound. Right now, we're celebrating that nickel has gone through $9 a pound. It's still well below the average price of the last 40 years. So, this just tells me that there's a lot of upside yet to the nickel price. And of course, the thing that's changed in the nickel market is electric vehicles. Historically, stainless steel has been 65 to 70% of the use of nickel. Batteries are now coming on. I remember about 3 years ago, they were about 3% of the use of nickel. I think that number is up to 6 or 7% now, and it's just growing rapidly as everybody switches to electric vehicles. I think the tipping point has come for electric vehicles, and the thing is that these batteries in electric vehicles require a lot of nickel in the cathode. The nickel is the metal that holds the electrons in the cathode. It's got excellent energy density. And so if you want your car to go farther on a single charge, you need to have a higher percentage of nickel in your cathodes. And that's where all the research money is being spent by the large battery companies, is how to do that. So the projections, for electric vehicles imply that you're going to need 40 to 70 new large mines to come on stream by 2040. That's a tall order. And by large, I mean, mines of a similar size to Turnagain, say on the order of 35,000 tons per year of nickel. I know of about 20 large undeveloped deposits in the world of nickel. And there may be some that I'm not aware of, but 40 to 70 is a pretty tall order. Now, this is a sensitivity analysis of our depreciated net present value at an 8% discount rate. This is a common metric in the mining business to measure value. And as you can see, at low nickel prices, this is a non-economic deposit. And let me say this is similar to all of the other large undeveloped nickel deposits of the world. That's the reason they're undeveloped, okay? And so they're all looking for higher nickel prices before they can get built, and we're in the same boat. What you also see here is that the depreciated net present value goes up rapidly as you increase the nickel price on this project. So at $10 a pound, which is just above where we're trading now, but still $1 below the long-term average price, we get to a PV8 value of about $500 million US. And if you take it to $12, you get to a PV8 value of well over $1 billion US. This is all compared to our market cap today is about 30 million Canadian dollars. So this is not for everyone. This is for aggressive, investors, of which I am one. I love this kind of leverage. So that's basically the investment thesis for people that have a positive view on nickel. This is a very leveraged way to play that call. This is a comparison of cumulative cash flow at $750 at $750 a pound nickel, which is the base case price that we use for our engineering report. And this is compared to HPAL projects, a similar size. And you can see that to get to like a 35,000 ton a year HPAL project, they're investing over $3 billion. And the economics are not as good as ours. Our economics are not good at $750 a pound nickel, as you can clearly see. HPAL projects are worse. Yet HPAL projects are getting built. And so that leads to a very interesting question. Why is that? Well, if you look at who's building them and where they're being built, you can start to understand they're largely being built by Chinese companies. And they're largely being built in jurisdictions like Papua New Guinea and Indonesia, in the middle of the Pacific Ocean, what they call the Coral Triangle, which is, by the way, in a very environmentally sensitive area of the planet. But the Chinese, I believe the explanation is that the Chinese are thinking strategically. They want to dominate the electric vehicle market and they want to dominate the battery market. They're already doing it. And, if you are a battery manufacturer, it's very difficult to imagine getting a long-term fixed price contract, at least at a reasonable price, from any producers of nickel, because the nickel producers can all see what's going on. And so the Chinese, by building these HPAL facilities in jurisdictions with low environmental standards, you can get things done very quickly. Even if they've got an internal rate of return of 1 or 2%, that's good enough because the Chinese cost of capital, of course, is very low, and it's all about the operating costs. And so by building these mines that are non-economic in Western terms, they're setting themselves up with long-term supplies of, at a fixed price of nickel and cobalt. So that's thinking strategically, and frankly, the Western battery manufacturers are starting to wake up to the danger that they're in. This strategy of the Chinese, I think, is quite successful. So other comparisons with these laterite projects that the Chinese exploit by using high pressure, high temperature acid leach. We're looking at building an open pit mine in hard rock. And so, it's a big hole in the ground. There is no way to extract metal from the earth without having some kind of an impact. The question is, what is the relative impact? With laterite deposits, they're thin, they're strip mines. They're not open pit mines, they're strip mines. And so they might be 10, as much as 20 meters thick, and they go on for mile after mile after mile. And basically, in the Coral Triangle, you're cutting down rare tropical rainforests to get at the dirt. You then take the dirt, you use high pressure, high temperature acid leach, and then the tailings in most cases are dumped into the ocean. So, in terms of environmental impact, there is really no comparison. In terms of carbon intensity, sulfide deposits such as Turnagain are inherently, they've got a lower carbon intensity than laterite deposits. And partly this is because of the very nature, of the deposit, the fact that there is sulfur in the deposit. But also, a lot of these projects in Indonesia, Papua New Guinea, they're powered by coal. And so, the laterite deposits have a higher carbon intensity than say, the average sulfide deposit. If you take nickel pig iron and you try and convert that to matte, which can then be processed into battery grade nickel, well, for one thing, that's a very expensive processing route, but it's also the carbon intensity is just off the scale. And just we modeled in the PEA, in our engineering report, we modeled our carbon intensity, and we are at the very bottom of the scale in terms of probable nickel projects. So the base case that we modeled is using diesel, a diesel mining fleet, and we come up with 2.24 tons of CO2 equivalent per ton of nickel. Now, if you were to use an electric fleet, which we didn't model because it's not available yet, we think, in fact, we know the market is moving that way, and sometime, in the next 5 to 10 years, you'll be able to buy, mining fleets that are all electric. If you do that, that takes the carbon intensity below 0.7 to 1. And then if you factor in CO2 sequestration in our tailings, which, we've done work with the University of British Columbia, we've got test work, we've got empirical data, and we've modeled that into our tailings. We could get actually to less than zero CO2 intensity for scope 1 and 2 emissions to take our product to concentrate. On our board, I just want to point out a couple of fairly recent additions. Martin Vidra, who is now our president, and he's a director of the company. He had a 30-year career at Sherritt International, which is a Canadian company that produces nickel and cobalt. He's an engineer. He understands all parts of the processing route, but he also sold nickel and cobalt to end users. So he knows them all very well, and they know him. And he is leading our discussions with potential strategic partners. Robert Morris, a director of our company, he joined our board about a week after he retired from Vale. Vale is the huge Brazilian mining company. It's a huge iron ore producer. It's also the largest single company producer of nickel in the world. Bob was in charge of worldwide sales of base metals for Vale, so copper, nickel, cobalt, precious metals. And that was a portfolio worth between $5 and $8 billion a year, depending on commodity prices. So this is someone else who knows all the end users very well and who the end users know. Both these gentlemen joined our company because they believe that this is a project that the world needs and that the end users need. And so it adds, I think, a lot of credibility to our project. This is something on our share structure. And this is a conclusion. We've got a very large deposit. We're advancing it. We make a high quality concentrate, but we can also take that and make a high quality mixed hydroxide product. And you need a lot of nickel and a lot of nickel projects in the next 20 years. So thank you very much for your attention, and I'll start looking at some of the questions now. One of the questions is, what's the state of infrastructure for your Turnagain project? Well, right now, it's early days. We're at the exploration and development stage. There is a road into our project, but it's very rough. It's, but all of that is baked into the engineering. So we do have infrastructure challenges at this project, but those are all factored into the engineering that we do. Here's another question. Do you believe battery and auto manufacturers will require carbon neutrality for their battery metal suppliers? That's a really good question. Require is a strong word. I think they're very interested in carbon neutrality. I think in Europe, they're going to start, at least they're talking about starting to measure the carbon intensity of imports, and that they would apply tariffs to imports that are higher in carbon. So that would lend an economic advantage to us. But I think it's more the consumers themselves that are going to require low carbon intensity. I think particularly in North America and in Europe that people that buy electric vehicles like to think that they're helping to save the planet. And if they're buying electric vehicles with Chinese-made batteries, well, they're buying very high carbon intensity. They're also helping to mow down tropical rainforests and dump tailings into the ocean. So it's not exactly saving the planet. And as this becomes more widely known, I think more consumers will care about it. If the consumers care about it, that'll drive the manufacturers in that direction. Here's a question: key milestones for next year in capital position. Capital position first, we're as of today approximately 3.2 million Canadian in the treasury with no debt. We've just finished a program up at the property of we've done infill drilling and we've done some geotechnical drilling, and it's all in support of collecting data so that we can do more detailed engineering to take the engineering to the pre-feasibility level. And we're targeting having a pre-feasibility report done by the third quarter of next year. I've got another question. Can you talk about Europe and North America's ability to compete with China in the battery business? Well, I believe that if the battery manufacturers don't secure long-term supplies of nickel and cobalt, as the Chinese have already done, I believe that they're going to get eaten alive by the Chinese. And I think that there's big battery companies that might not exist 10 years from now if they don't wake up. And I'm seeing signs that they are starting to wake up. They're starting to realize that the strategy that the Chinese have of, building mines to secure the supply is a very competitive strategy. So can they compete? Well, certainly they can. Will they compete? That remains to be seen. And here's another question. Do I think it's possible to get a clean and ethical supply of nickel in North America in the next 5 to 10 years? Well, yes, I think we can provide that. So there you go. And that's all the questions I'm seeing for now. So I'm just going to, unless there's any more questions that show up, I'll wrap this up. And if you have any more questions that you think of later, you can always contact myself or Holly. You can check out our website as well. Thank you very much for taking the time to listen. I appreciate it. And see you next time.